Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Let me take a look at the first example here. So this is a calendar spread. This is example one. And we're looking at a long calendar call spread. And when I say long calendar call spread, I'm talking about the strict definitional calendar, which is I'm buying a long-term call and I'm selling a short-term call. And what I did here was I put this deck together, as I said, back in early January. I think it was around January 9th or so, if I'm not mistaken, and I think we'll see that when we look at some of the chart pictures that I snapped a little later. And what I was looking at was basically a 2-month calendar spread where I'm going to buy a March expiration, which by coincidence just happens to expire at the end of this week in about 3 days, and I sold the January expiration. If it was January 9th when I did these, January expiration was probably right around January 20 or so. That means that my front month options, the one I sold, probably had about 2 weeks until expiration, and the option that I bought probably had about 10 weeks until expiration. So I'm selling a 2-week option and I'm buying a 10-week option. Now all sorts of strange things can happen when you do that. There was some discussion earlier about volatility. You can have a difference in volatility from a short-term option to a longer-term option. If the market's been particularly volatile, and I think as Mark was saying previously, or Steve, I'm sorry, as Steve was saying previously, the volatility on currencies has settled down somewhat. So the January volatility at the time I was doing this trade was actually a little bit higher than what we see right now. And the cost actually of the options in March might have been a little more expensive than what they might be if you did them right now, because things have settled down. That causes the options to get a little bit cheaper. But let's take a look at this particular example and sort of break it apart and see what kind of sentiment we've got, where we make money, all those sorts of things. The first thing I want to look at is this is a long call calendar spread. So I'm buying one call in a distant month, which is March, selling one call in a near month, which is January. Both of them have the same strike price. In this example, I was using the Australian dollar pair, which is the AUX. And my direction here is I'm neutral in the near term, which is between January 9 and January 20, and I'm moderately bullish over the long term. If that's my thought, in other words, if I think the dollar is going to be relatively flat with regard to the Australian dollar in the near term, but then I believe the dollar is going to gain ground. I did that based on what the chart looked like to me, what I knew about what was going on geopolitically, what we were doing with regard to all this huge list of stimulus packages that we have going on, interest rates that have been cut, all those sorts of things. Trading currencies takes into account just about everything that's going on geopolitically as well as domestic, and I think some of you that have done these understand that. So I came to the determination that I was moderately bullish in the near term or neutral, but overall I think the dollar is going to gain ground. Now I've had a lot of discussions with people about currencies, and they will tell me, well, hey, the United States is printing money faster now than it's printed money at any time since the Great Depression of 1929 in the 30s, and that's true. However, the thing about currencies is you have to realize that everything is nothing is in a vacuum. Everything is relative to everything else, and that's the whole point of these currency pairs. Is it's not necessarily how well is the dollar doing or how strong is the dollar doing, but it's how strong is the dollar relative to the Australian dollar. Because the only way you can determine the value of a single currency is by a relative comparison to another currency. And these pairings allow you to do that. So a lot of people would say it doesn't make sense to buy the US dollar right now because they're printing a lot of dollars. That obviously is going to create dilution of the dollar, and that means inflation, right? That means that there's so many more dollars out there that are available that the cost of everything is going to go higher. Well, I think in a very long-term perspective, there may be some merit to that argument. But in the short term, if you were a country anywhere in the world and you have money to invest, the truth is most of that money is still coming to the United States and still investing in treasuries, because despite all the problems we have here, and despite your position on whether or not we may have even caused all of the problems that exist around the world, we're probably in a more solid position than many of the other countries in the world. And so even if our dollar gets diluted, it may still be a more safer haven than some of the other currencies. So again, I'm not trying to say that's true or isn't true, but I'm saying those are the arguments that I hear on both sides. So in this example, I'm looking at the chart. I know what's going on with the interest rates. I understand some of these stimulus packages that are going on. And so I want to take a position where I think the dollar is going to stay relatively flat here, but I believe maybe that the United States is going to pull out of this recession before anybody else, mostly because we kind of got into it before anyone else. And so I think in the long haul, the dollar is going to gain value. And long haul in this example, again, is only a few months out. If I was going to go out a couple of years, I might have a different perspective, but maybe I'm looking out just a few months. And I think the dollar's got the ability to gain ground, because certainly our recession's not going to end in 2009, but we may well see some progress before the end of this year. And it's likely that we'll see some progress potentially faster or sooner than some of the other countries. Anyway, let's move on from there. So at the time I put this together, the AUX was showing a value of about 140.26. That's quite a bit lower than where it is right at the moment. The spread that I chose to do was a 140 strike price spread. I went out and looked at the 140 calls. They were priced at about $8. The 140s for January were priced at $2.50. I could put this spread on for a net debit of $5.50. And again, what's interesting about this spread, as well as many other spreads, is the fact that typically the net debit is the worst that you can do. You're not going to lose more than $5.50. Now, a lot of people might say, well, why don't you just go on out there and buy the 140 call for March and be done with it? That's bullish, right? True, but the cost is going to be $800 instead of $550. So part of the reason that you sell the short leg on almost any spread is to generally bring in a little money that helps offset your cost, and your overall cost basis goes down, therefore your risk goes down and your max loss goes down. Now, one of the things you should do on almost any spread that you do, and this is no exception, is that before you put the trade on, you ought to know, where does a stock have to be in order for me to make money? Where does it have to be for me to lose money? What's my break even? What's my maximum loss? What's my maximum gain? Those are all the numbers and calculations that you probably should do before you place a trade, because if you're entering into a position and you don't know where the stock needs to go or where the underlying index needs to go in order for you to make money, how do you know if you're going to make money? I mean, it's possible in many cases to set up certain types of trades that can't make money. So if you don't know how to calculate those things ahead of time, you shouldn't be doing the trade. You really need to. Now with calendars, it's a little more complicated, because I have to calculate not only a short-term break-even, max gain, and max loss, but also a long-term break-even, max gain, and max loss. Short-term, which is between the day I put the trade on and the first option expiration, in this case January 20, and long-term, the period of time between January 20 and about March 20, or I guess March 20 in fact. So first calculation I want to do is my short-term break-even, and the formulas are very simple, but it's essentially this. I'm going to take the strike price plus the net debit amount, which is $5.50, minus the value of the call, of the March call. That's going to give me one break-even, and my second one is the strike price minus the value of the March call. So there are two break-evens, and if you look at the little profit and loss chart that I'm showing you here, the green is where you make money, and notice at the bottom there's a note that says strategy at near-term expiration. This is what this particular strategy will look like as of the January expiration. The green area is where you would be profitable. The red areas are where you would not. So in order to calculate break-evens, you got to calculate both of those points where that line crosses over that $0 line and goes from the red zone into the green zone. So the first calculation is the strike price of 140 plus the debit of 550 minus the value of the March call. Now here's the challenge. A lot of spread strategies allow you to do a calculation as of expiration, and it's very simple because an option always has one of two values at expiration. It's either worth 0 if it's out of the money, or it's worth the amount that it's in the money if it's in the money. So it's a very simple calculation. The challenge with this one is that it's impossible to know exactly what a March option would be worth at the date of the January expiration, because you don't know what the volatility is going to be and things like that. So the best thing to do is to use a tool like we have on Schwab.com, like we have on the Street Smart Pro software, where you can do a forecast.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.